So in this video, I'll go over 10 things you should never do when investing. So whether you're new to investing or someone that has a bit of experience with it, these 10 things are something you should avoid if you have any plans on being successful when it comes to investing. So let's start with the first one, which is investing money you can't afford to lose. Now, obviously for a lot of people, one of the biggest fears, of course, when it comes to investing is losing money, right? But a great way to prevent that from happening is obviously is allocation, right? You want to make sure you create a budget, right? A budget is going to be very important for something like this because obviously you need to understand how much you can invest, whether it's on a weekly basis or a monthly basis. So if you're someone that has a budget, because for a lot of people, you don't want to be in that position where you're like, oh, I have some money, let me just use this money and invest it on the market, right? If that's your life savings, you don't want to be taking your life savings and just throwing it in the market or throwing it into real estate or throwing it into business, because if things don't go well, then you're going to lose all that money, right? And so you want to try to avoid that. So make sure having a budget is going to be crucial. So let's say you have obviously you have an income, you have a job, you have income coming in. You want to make sure you break that, whatever you make monthly, you want to make sure you break that down into percentages, right? Obviously, most people would recommend that you try to invest like at least 10% into like investments, but depending on your situation, depending on your financial situation, you're going to determine what's best for you. But the first thing you want to do is you want to put some money aside, 5-10%, to say, all right, I'm going to use this money to invest, whether it's in real estate, stock market, or whatever it is you want to invest in. And then you're going to leave that rest to make sure you're paying your bills, obviously housing, your necessities. So you want to make sure you have that covered, but you always want to try to pay yourself first, whether it's 5, 10, 15%. You want to make sure you put that aside and say, all right, I'm going to use that money to invest in whatever I'm going to invest in. And that's the thing, like, even if, let's say, whatever investment that you use, whether it's real estate or a stock market, goes to zero, at least you still have your needs covered, right? That 5, 10, 15%, if you lose that, at least you have everything covered and you're not going to lose your shirt. So you want to make sure whatever you make every month, you want to break that down into percentages and make sure you allocate that to investing. So number 2 is putting all your eggs in one basket. Now when it comes to doing this, obviously you heard the method of diversification. Everyone talks about how important diversification is, and it's almost similar to like creating a budget, right? Except that you have a portfolio and you have like certain monies allocated to certain sectors or a certain say whether it's real estate or stocks, business, whatever it is. You have certain allocations within that within your portfolio, and it's important to not just be stuck or all in on one sector of your portfolio, whether it's just real estate or just all in the stock market, because if something happens in the real estate market and then you have all your money invested, obviously you'll lose all that. So you want to make sure you have your asset, your portfolio is diversified in all different types of whether it's businesses, whether it's stock markets, real estate, and even when let's say you're just investing in the stock market, you want to have you don't want to have all your eggs in one basket in terms of a sector. Like you maybe want to have money in certain like tech stocks, or you want to make sure you have it in health stocks, or maybe you want to have it in the S&P 500, or whatever it is that you're allocating your money to. You don't want to just have it in one sector, because let's say let's say you have REITs, right, real estate investment trust. You have all your money in REITs, and then the real estate market goes down, you're going to lose your investment. So you want to make sure you're diversified in REITs, on tech stocks, healthcare stocks, whatever it is, and make sure that you're allocate and diversify. So you want to make sure to put all your money in like one basket, because obviously if anything happens in the market, you're going to be losing all your money. Number 3 is chasing hot tips and trends, right? Now we all have like friends and families that say, oh, you should invest in this, you should invest in crypto, or you should invest in this, tech stocks, or you should invest in Apple. We all have people that have make recommendations. Then also you have trends, like everybody's saying, oh, get into real estate, or just get into the tech stocks. Now, maybe they're right, maybe they're wrong, but you never want to just be going base your investment on certain tips on people are saying, or based on trends. You want to make sure you're doing your research, make sure whatever plan you have based on your portfolio, based on your financial goals, you want to make sure you're doing research based on your goals, because your goals are different from what they're trying to do, and you don't want to just be going blindly into that, right? And for a lot of people, especially on YouTube, there's a lot of people in the financial space that says, oh, invest in this, invest in that, and you can see that in FTX. A lot of people got caught up in that, and for a lot of people that people that are watching, they lost a lot of money in that. And so you want to make sure you're doing your research and understand that. And it's understandable, because like these are people that you trust, and you're like, what, if they're doing well financially, so these are people that I'm going to trust. But you also have to understand that, look, man, you don't know how much money they have invested. They could lose money, but they'll be able to be fine after they lose that money. But you, depending on how much you invest, that could be something at a substantial amount. So you want to make sure you're always doing your research and just don't go into blindly following other people's investment advice. Number 4, investing in something you don't understand, right? Warren Buffett talks about it all the time. He says he doesn't invest in anything he doesn't understand. And that's for a lot of people. They just, like I said, like even to my last point where you're following trends and advice from other people tend to say, oh, you know what, this person invested in this, so let me just invest in that as well. If you don't understand it or understand how it works or understand what affects that certain stock that or investment that you're investing in, you need to make sure that you do more research, because if you don't understand how it works, you don't understand what affects it in the market, then there's a high risk that you can lose that money, and that's something you don't want to do. So make sure if there's something that you use, something that it's a product or service that you use and you understand it, and you're like, you know what, I've done my research, I want to invest in it, then that's probably the best way to go. But don't just say, you know what, I don't understand what it is, but you know what, my boy over there is investing in it, I should do the same. That's obviously the wrong thing to do, and you need to do more research when it comes to that. Number 5, letting your emotions dictate your decision. Now, I know firsthand during the pandemic when I started getting into the investment and the pandemic happened and the market went down, I took my money out. That was the wrong move. I should never have done that. But being someone that was new to investing and not really understanding like how to control my emotions and really being having the experience of dealing with a volatile stock market, you want to make sure you control your emotions, right? Never get too afraid, never get too excited when the market is going up or going down. You need to make sure you think about your long-term goals and really understand the history when it comes to that investment, whether it's real estate, stock market, business, whatever it is. If you understand, how it works and, understand, like if you look based on history to see how things happen and really get to learn through history, then you understand that, the markets, whether it's real estate, stock, that it's very volatile and there's crashes, right? It goes up and down, but you need to make sure you control your emotions. Never get too excited, never get too fearful. Just make sure you're consistent and you understand what comes along with investment. So you want to make sure you stick to your long-term plan, because you understand this is a long-term game. So you want to make sure you stick to that, understand that, and then understand that regardless of what's happening in the market or whatever that investment, that you know that in the end, as long as this is going up, you'll in the end you'll be successful at it. Number 6, timing the market. Look, none of us understand how the market works, right? We know that if you're someone that's trying to predict short-term movements within the market, then good luck, man. You should be a billionaire by now, right? But we understand how challenging that is, right? We have no idea how the market works, so like what's going to happen within the market. I mean, we have our ideas, we have our senses, but in reality, we have no idea what's going to happen. So you want to make sure that you understand that there's no way to really time the market, right? Some people say that it's better, time in the market is better than timing the market. You want to make sure that as long as you're being consistent with your investment and understand that, I've done my research, I know exactly what to expect, that as long as you're in the market working and being consistent with your investment, then in the long run it should work out, right? Unless something catastrophic happens, long term, 5, 10, 20 years from now, it should work out as long as you're doing your research and you understand what you're investing in and you're controlling your emotions, you have your finances in order. You understand that time in the market long run is going to help you be successful when it comes to investing. So understand that timing the market, it's very hard to do. Only like the top 1% of people can do that. And you're not, unless you're that top 1%, you're best off just making sure you have time in the market. So number 7, paying too much in fees, right? Now, obviously when it comes, this is in particular, especially when it comes to the stock market, you have to be careful with this for a lot of people, that whether, depending on what kind of investment you have, whether it's an actively managed portfolio or it's passively managed portfolio, you need to be aware of the fees. For a lot of people, like there's people that have been 10, 15, 20 years down the line, and when it comes time, they're like really collect their money and they look at the fees and they say, wow, that I paid this amount of money in fees, and you'll be surprised how much it is, man. It's like thousands, tens of thousands of dollars, $100,000 that are fees that are taken away if you're not aware of it. So you usually see these high fees in like actively managed profiles. So as long as you go in there, if you're going to be someone that's going to work with someone like a advisor, you need to be aware of the fees and how much they charge, because that could really eat into your wealth long term. So I think for a lot of people, you need to make sure you're aware of your fees and don't go in there blind. Like ask questions and really understand, like, all right, how much am I paying to invest in this certain investment. So number 8, failing to review and rebalance your portfolio. So like when I talked about before about budgeting, like making sure that you understand your allocation in terms of investment. one thing for a lot of people that they want to say, all right, I want to have 20% of my money in real estate, 10% in stocks, 15% in art, and so and so. So, and people like to stay within that allocation because just in case there's a downturn in real estate, obviously 20% of their portfolio is going to be affected. So what tends to happen, especially with stocks, is like, let's say a tech stock is overperforming, right? You say you have 10% allocated in tech stocks, but you see how tech stocks are doing really well right now, and that 10% goes up to like 15, maybe 20%. Then you can see that portfolio overperforming. So that means if something happens with tech stocks and you leave that 20%, then 20% of your stock is going that your portfolio is going to be affected. So it's important to rebalance. And if you have any brokerage account, what tends to happen is let's say if your tech stocks are overperforming by 10%, what you're going to do is that you're going to sell some off to get back to that allocation. So that's what you need. So you need to make sure you review that so you're not too much in one particular sector. So you want to make sure you do that. And one app that I use, like M1 Finance, the good thing about them is that, let's say you have your allocation, what happens is instead of you having to sell your certain stocks or something like that, which will have tax implications, what M1 Finance does is they'll take whatever. Let's say you're investing $1,000 a month, and they see that one portfolio is overperforming the other. What they'll do is they'll allocate more resources to that underperforming stock to get it back up to a certain percentage. So M1 Finance kind of rebalances your portfolio for you automatically, instead of you having to sell off some stock or buy more stock or anything. But you want to make sure that you're reviewing your stock anywhere from 6 to 12 months every year, and then make sure make sure your allocation are right, are where they want it to be, so you're not overperforming or underperforming in any particular sector. So that's always important. So make sure when you're investing, you want to make sure that you review your stock, your portfolio, and make sure that you're not allocated too much into any particular sector. Number 9, borrowing money for your investments. Right? All right, you don't want to be going into debt for you don't want to be borrowing money. You put buying stocks or buying real estate on credit cards or personal loans. You don't want to do that, right? You want to make sure you're smart with your money. Obviously, if you want to buy real estate, you're going to take on a mortgage, but you obviously want to be smart with your resources. You shouldn't be taking let me get this credit card to pay to buy some certain stocks or buy a certain investment. That's just the wrong thing to do. If you haven't have cash to the side to make sure your investment, like I said, if you have a job, you have income coming in, you need to allocate certain percentages to investments. If you're not doing that, then that's just the wrong way you're doing it. You're taking a lot of risk, right? Obviously, if something goes wrong and you lose a lot of money, your investment doesn't go well, you still have to pay that debt, right? So you never want to you try to avoid that at all costs. Especially when it comes to consumer debt, like credit cards, you never want to get put in that position, because if your investment doesn't work out, you're still gonna have to pay even higher interest on that debt. So if you can avoid at all costs, never ever try to avoid borrow money on investments, unless let's say you're taking on a mortgage and that money is gonna be making money for you. And the final one is lack of patience and persistence, right? All right, you need to understand that investing is a long-term thing, right? It's a long-term investment. It's not fast money. It takes time to gradually build up to building wealth, right? So you need to make sure you're patient and you persevere, because, like I said, when it comes to investment, there's going to be ups and there's going to be downs from year to year. But you need to make sure, in the long run, have a long-term view of this and know that in the long run, you should have a successful investment as long as you did your research and you made you done your due diligence, and you made sure you made the right move. So you want to make sure you always keep that in mind. This is a long-term gain, especially when it comes to investing like stocks and real estate. Think of the long view. This is something that you're building wealth over time. Wealth is not built in a day. This is something you're going to be building long time for future generations. So that's something that you always want to keep in mind. And remember, investing is unless you're doing day trading, which is that's a daily thing, but you want to have that long-term thinking. So that's all I got for you guys today. If you got any comments or questions, make sure to leave it down below. Hit the like button, share, and if you haven't done so already, make sure to subscribe. All right, so you guys take care. Have a good one. Later.